The Reserve Bank of India has been active on rates and liquidity. In simple terms, Sandeep, how is this affecting the broader economy? And how are you adjusting your fund strategy in response?
What we gather is over the past 1 year, all the shops and all the smaller and medium sized enterprises are weathering a slowdown. Banks are very cautious right now to lend to these retail and smaller sized ticket loans for consumer durables and things like that. RBI has decided to turn the tide. They've cut repo rates by about 100 basis points over the last 6 months down to 5.5% now. What it means is it will make loans cheaper for everyone to borrow on a short term as well as a medium term time horizon.
So, what we've noticed is that NBFCs and consumption often lead when rates fall or when liquidity is high. So, tell me, Darshan, why do these sectors benefit and how is that influencing your portfolio calls?
So obvious benefit is that the EMIs come down. Secondly, it leads to lower incremental borrowing rates, which in turn helps improve the household budget. So last year the budgets were constrained and that led to a significant slowdown in the consumption. Now that the rates are lower, the EMIs are lower and the personal loan rates or even other forms of borrowing rates have come down, it helps them to free up the budget and which in turn they can use to spend on a variety of areas.
Market Thalaivas, brought to you by Sundaram Alternates.
Welcome to another episode of Market Thalaivas, where sharp minds decode sharp moves. This is your front row seat to insights from the team at Sundaram Alternates, bringing you expert perspectives on the trends shaping India's investment landscape. I'm your host, Aishwarya, and today we're diving into the forces driving market sentiment, from the RBI's policy signals to the government's bold capex push, and what it means for investors like you. Joining us today are two sharp voices from the Sundaram Alternates equity team, Mr. Sandeep Tulsiyan and Mr. Darshan Engineer, fund managers at Sundaram Alternates. Mr. Sandeep Tulsiyan is a seasoned investment professional with over 17 years of experience in equity research and portfolio management, known for his analytical depth and sectoral expertise. And Mr. Darshan Engineer, he brings over 16 years of experience across equities and credit, with deep insights into sectors like auto, pharma, IT, chemicals, and consumer discretionary. Gentlemen, welcome to the show. Let's get started.
Hi, thank you, Aishwarya. Looking forward to today's session.
Yeah. Hi Aishwarya. Thanks. Looking forward to another round of Market Thalaivas.
Okay, thank you so much for the introductions, both of you. So let's start with the big picture. The Reserve Bank of India has been active on rates and liquidity. In simple terms, Sandeep, how is this affecting the broader economy and how are you adjusting your fund strategy in response?
Sure, let me make this quite simple for you. Our team does an extensive channel check across all the tier 2, tier 3 towns, spanning across a plethora of consumer durable shops, paint shops, kirana stores, and all of that. What we gather is over the past 1 year, all the shops and all the smaller and medium sized enterprises are weathering a slowdown. If there's a big appliance buyer who's waiting to buy, say, a refrigerator or a TV, they are postponing their purchases. Similarly, homeowners who are wanting to make some home improvements like getting the house repainted are also waiting it out because of their budgets being stretched. So what are the main reasons? Number one is the higher EMI rates. Banks are very cautious right now to lend to these retail and smaller sized ticket loans for consumer durables and things like that. Even though the incomes haven't dived for these consumers, what we are seeing, these families are not feeling very confident of spending money out, which means their spends are restricted to only on essential items and not on discretionary items. So how is RBI come into play with this? RBI has decided to turn the tide. They've cut repo rates by about 100 basis points over the last 6 months down to 5.5% now. What it means is it will make loans cheaper for everyone to borrow on a short term as well as a medium term time horizon. We are seeing that almost overnight the EMI offers on all of these purchases in consumer durables have come down by almost a percentage point. We think this will lead to more foot traffic rise amongst all of these shops. All the consumers who have decided to pause their purchase now will probably go up and spend that money into these shops. On the other side, the borrowing costs for these shops will also come down. This will help them to stock more items in their shop as well as the working capital line, which they usually extend with their local bank or the local NBFC, that would also come down, giving them more headroom to have more inventory at their shops. So there's no more fretting over these higher interest charges. Secondly, what has RBI has done is also they have brought down the cash reserve ratio by about 100 basis points to almost 3 percentage points. Now, what this will do is this will inject a fresh liquidity into the system. All of the durable shops, the paint owners and the kirana stores that I spoke about, they will receive a better credit terms with their banks and their NBFCs who they usually deal with. Also, the suppliers would get a better credit term, which would help in turn stock them more items at their shops. And RBI just didn't stop there. They also tweaked the variable reverse repo auctions to fine tune the liquidity which is into the system so that there's no excess liquidity driving up inflation. This is essentially keeping the overnight rates steady. Also, the risk weights which were assigned to these retail loans as well as the microfinance loans, which are typically backed by NBFCs, has been brought down. What will this essentially do is it will help banks to fund NBFCs at a cheaper rate. And in turn, these loans will be lent out to microfinance borrowers, and even small ticket size, small business owners. I mean, think about it like a small cafe owner or a street food vendor or things like that. In turn, just a month after this, we also saw RBI releasing their financial stability report. Now, what is this? This is typically a semi-annual health check of our financial system. Typically, what this report does is it gives key parameters on how the economy is doing, where is the current financial health of the system, which indicates that the current banking sector is flush with funds. They are having very high capital buffers. The CRAR ratio is right now at 17.3%, which is a record high. Secondly, the NPAs or the non-performing assets are at a decadal low. The GNPAs are at about 2.3%. The net NPAs are at just 0.5%. That means NBFCs are able to do away with very low credit costs. Also, they're able to maintain their profitability because these stressed assets in the system have gone down. Also, RBI mentioned that inflation has been easing significantly. It was down to almost 2.1% in the recent survey, which is the lowest number in the last 6 years. If you look at the foreign exchange reserves, they are hovering at around $700 billion, which is enough to cover roughly about 11 months of our imports. So on an overall basis, I think the economy looks on a fair footing if you go by the RBI's financial stability report. But they still sounded a bit cautious because of the unsecured retail credit growing slightly faster than what they had anticipated, which is restricting them to keep the GDP growth forecast at 6.5%. And they have not increased it as yet. But in our view, we feel there is an entire probability that this 6.5% number would be upgraded by second half of this financial year. Lastly, where do we go from here? Other than RBI measures, there's also the tax cuts which will come into play in the second half of this year, which will probably in turn drive the consumer spending, the overall confidence that the borrowers would get to fill up their shops with working capital loans and things like that. That will lead to a lot of savings. An average individual who earns anywhere about, say, 12 lakhs and plus will save more than 80,000 rupees. And the spendings, which were largely into the essential items or everyday items, we believe these spendings would move into discretionary items, which will give a fillip to categories like paints, two-wheelers, mobile phones, home improvements, and things like that. So on a macro level, we think this higher consumer spending will drive a higher factory utilization level rates. And a higher factory utilization means the factories will churn out more production and they would need to work in more number of shifts. These more number of shifts are likely to drive more job postings, which will probably be higher than the number of layoffs that's happening. That will in turn kick in the whole flywheel effect. Inflation is likely to remain benign because we're not seeing any increase in the raw material costs. The commodity costs are pretty stable, which will in turn help the RBI to keep their rates stable. Hence, we think the second half of this year is something that we are looking forward to in terms of the credit growth coming back, probably being higher than GDP for the first time in many years now. And the overall confidence that is leading to the lending by NBFCs would get a fillip. I think with a proactive RBI at the helm of affairs in India, we are quite confident that the credit growth will return back in full fervor. So that's essentially how we're looking at it, Aishwarya.
Okay, great. Great to hear. So, moving on to the government side, my next question is for you, Darshan. The government is stepping up on capex, especially with private sector spending still muted. So, how do you see these moves, like infra investments, shaping up the economy?
So thanks, Aishwarya. So thanks, Sandeep, also for giving a good introductory remark on the RBI policy and how it percolates into the real economy. So when it comes to our Indian government, you must have observed that in the past 10 to 15 years, the government has spent a lot on improving the supply side of the economy. Now, what do I mean by supply side? What I mean is that it is upgrading or building out a lot of infrastructure which is then used by factors of the economy to improve the flow of goods and services into the economy. Now when I say infrastructure, it is not only hard infrastructure, physical infrastructure like say roads, railways, airports, power, defense, etc., but it is also social and digital infrastructure. We have seen the rise of UPI and how it has really helped improve the flow of money into the system and reduce the usage of cash. Although on an absolute basis, cash continues to remain continues to grow in terms of usage, but the introduction of digital infrastructure, UPI and Aadhaar stack, as well as improvement in railway, roads, a lot more airports, has also meant that the flow of physical goods, people, has improved significantly in India. Just to give you some additional statistics, so for example, the central government capital expenditure in the recent April to May 2025 period improved by 54% to almost like 2,21,000 crores. And this was almost like 20% of the total budgeted capex for this financial year. And this is further expected to accelerate going into the coming quarters. And therefore, I think that over the next few quarters, you will see an upward revision in the overall capex outlay, which is right now budgeted at around 12 lakh crores. Now, this implies that the growth will be in double digits and there will be further improvement expected as well. Just to give you one more statistic, the manufacturing PMI in June accelerated to a 14-month high, which is at around 58.4. Uh, there are some additional factors that we need to look at. Now, one of the aspect about the government capex is the fiscal deficit. Post COVID, the government had to embark on a significant increase in the fiscal deficit in order to boost the economy, which had gone into a slump, and therefore the fiscal deficit had increased to a significant extent, almost like reaching 7 to 8% of the GDP. But unlike other economies which continue to maintain high fiscal deficits, the government of India reduced the fiscal deficit structurally over the next few years. And it was also helped by a benign crude oil price environment and raw material prices. In addition, RBI is also supported by paying out very good dividends over the last few years. That has helped government to bridge the fiscal deficit and narrow it to around 4.5% and below. This what it means is that it helps to improve the quality of expenditure that government does. So otherwise, the government is forced to spend more on revenue expenditure, but by reducing fiscal deficit and improving the quality of expenditure, you help improve the infrastructure as well as the longer term benefits into the system. For this year, we expect that fiscal deficit will be around 4.2 to 4.3%. Now, how does this translate to the real economy? When you build out a lot of infrastructure, both on physical as well as digital front, it leads to a strong demand for a variety of capital good and equipment players as well as services company, which in turn means that they get much better order inflows. They also get much their order books improve significantly, and also it helps them to improve their absorb their fixed cost and therefore improve their balance sheets and financial profile. Now, how does it lead towards improvement in better orders, more positive business environment means again better job outlook at the base of the pyramid, which in turn again means that it helps to the real economy to grow in a much more structured and a consistent manner. Uh, so we have seen multiple sectors benefiting from this infrastructure investments being done by the government. So, for example, we have seen the rise and much more positive impact on equipment players who supply equipment which are used in infrastructure development, say in power or in defense or in roads and railways. And we have seen multiple new companies coming into the equity market for capital raising because they require capital to grow as well. So overall, I think the government has taken a series of steps which has helped improve the financial profile as well as the business outlook for the real economy and obviously for the listed markets as well. Thank you.
Thank you so much for your answer, Darshan. Building on the theme of government spending, capex heavy sectors like capital goods are expected to benefit from most. So, from your fund's lens, Sandeep, how are you spotting the most promising plays in these spaces?
Sure. I think Darshan touched upon an important point, which I'd like to borrow, is the manufacturing PMI. The manufacturing PMI is right now close to 58.4. Usually, any number above 50 signals expansion, any number below 50 signals contraction. So at 58.4, we are actually at a 14-month high. What does this do? It essentially means that there's a big amount of capex push that is being done by the government. We are yet to see any green shoots on the private capex side. It's largely the government capex which is driving much of this push on the manufacturing PMI. So how do we capitalize on this? Essentially, government capex push means investments into large ticket projects in, let's say, roads, ports, railways, and things like that. And from our funds perspective, how do we capitalize on this trend? Because a lot of these large projects are also capital intensive in nature. So although there's growth, they may not necessarily be generating the same kind of IRRs what one may expect, which causes a lot of uncertainty. So at Sundaram, we have a preference for the companies who are supplying equipment for these projects rather than the companies who are running these projects. So we look at the capital goods sector, which is one of our highest allocations in terms of the portfolio as compared to the other sectors or as compared to the benchmark as yet. But we don't make the mistake of painting the whole sector with the same brush. No, because there we can get it wrong by misjudging the demand supply dynamics. So essentially what we do is we look at all the different sub-segments within capital goods. So we have power equipment, we have railways equipment provider, defense, infrastructure, EMS companies, and the core industrial companies. We are positive on, let's say, a few of these buckets, but not all. But I'd like to bring your attention to the segment of power equipment where we are the most positive. Say, over the last 10 years, I've been tracking this sector for more than a decade now. What we have seen is this sector has undergone a significant pain. There's been capacity addition, but at the same time, the equipment providers have not really been able to generate a very high ROC or create a lot of, let's say, market cap and wealth for their owners. So what has changed now? Things have changed because this whole sector has undergone a transformational journey. There used to be very high power deficit a decade ago, which is now almost you can get around the clock kind of a supply. Interestingly, in the month of May, the day ahead prices saw a significant fall to almost 11 paise per unit during a certain hours of the day, essentially meaning that most of the power that was being supplied to the grid was matched by demand. In fact, the demand was slightly higher than what the supply was at that point in time, causing this fall in prices. So how did we reach over here from a significantly higher power deficit, which was touching double digits a decade ago? See, India has invested a lot into the newer power reforms. The power discoms or the distribution companies were in a very bad financial health. Government has introduced various reforms to improve their financial health. This has led them to invest more into the transmission capacity or the transmission equipment, which has brought down their losses and in turn brought down the power costs overall for the private sector. If you look at the total capacity that India has today, it is somewhere close to 470 gigawatts. And roughly 50% of this is being fueled by the non-fossil fuel energy or the renewables. But in the last decade, we've seen the solar prices, they have come down by 65 to 70%. And in terms of the number of installations, we've seen it gone up by about 40 times higher. So where does this bring us? Can we just keep on going and installing more and more solar power plants? No, we cannot do that because they face a big challenge. You cannot generate power through solar source of energy around the clock. That means you will generate power during the day, but during the night, you need the other sources of energy to kick in to ensure that you have a consistent around the clock supply. And that is why investments will have to be continued in the thermal power side. Because if you try to store the entire solar power generated into batteries, it's not going to be very cost efficient as on date. Sure, battery prices are coming down, but we are not there yet where they would match up to the other sources of energy. So the way we are playing this theme is we are playing on few surviving companies who are still providing equipment to this thermal power producers. And there are very few left which are flush with their order book reaching a multi-year high. Even their order book to sales ratio covers their revenue visibility for the next 4 to 5 years. So that's where we are quite positive. Now, what is the second leg? The second leg on the power generation side is the power transmission and distribution, where we are looking at the investments that are being done on the power transmission side was significantly lower over the last decade. Typically, this sector follows a rule of 1:1. That means if you spend 1 rupee on generation side, you will have to spend a proportionate 1 rupee on the transmission side as well. But over the last decade, this ratio has been 1:0.6, which means the transmission sector has been significantly underinvested. Now, if India wants to double its overall capacity, the non-fossil fuel capacity over the next decade by 2030, these capacities would ideally come in certain pockets where you have very high solar power generation or very high wind power generation. You would need a lot of power evacuation infrastructure to get this power from the generation source to the consumption source, to the consumption areas, I would say. And for that, you would need very high powered transmission lines, which will have minimal amount of losses so that the power can be supplied at an affordable rate. So there are very few companies today who manufacture these kind of sophisticated transmission lines and transmission equipment. You need to have investments into power grids, into grid stabilization equipment, as well as smarter equipment which can schedule energy in a smarter way to bring down the overall cost and manage power fluctuations at the same time. This entire gamut of investments across the upstream as well as the downstream power T&D is where we are interested. On the upstream side, you would have high technology intensive companies who control the technology for these kind of equipment like HVDC lines, SCADA systems, and things like that. On the downstream side, you would have companies like cable providers who provide cables, conductors, and other equipment for the distribution at the distribution end. So that is where our entire portfolio is today focused towards. But there's also an additional leg that we are forgetting, where we are exposed today is on the exports of this equipment. Now, India is very close to signing a treaty with US in terms of the tariffs. So we feel that overall equipment exports from India is likely to see a strong demand because even in US, you are seeing a significant addition in terms of the overall power capacity. This is led by huge investments into generative AI and the generative AI-led data centers. And there are very few companies in India who provide these specialized equipment for this kind of a power capacity addition setup. I would like to share a very quick example over here. So there's this company called Learning Resources in US. It's run by an 80-year-old entrepreneur. His name is Rick Waldenberg. He gained popularity very recently because he has a toy company based out of US and he has sued Mr. Trump over the tariffs imposed on China. Now, why did he do that? He did that because 60% of his toys were imported from China And they had a plan in place that if tariffs were imposed on them, even then with a little bit reduction in cost, a little bit pass through of prices to consumers, they will be able to wade through the entire tariff regime. But the tariffs that were imposed were significantly higher than what they had thought, and they couldn't squeeze their suppliers beyond a certain extent. So, what was the only option left with him? He has to migrate and relocate his production to some of the other countries. Guess which countries came up to top of his mind? That's India, Vietnam, and Cambodia. Yes, overnight he could ship some equipment on a trailer bed and put up a plant in Vietnam. Within India, they are actually evaluating many different locations today because the cost of production is significantly lower and it would come closer to the manufacturing cost that they were getting in China. So we would see these kind of investments happening in India and the overall exports picking up over the next 3 to 5 months, which will largely be led by a favorable tariff impact on the Indian economy versus the other Asian peers. So that is another area where we have some specialized companies who provide these specialized equipment, which will benefit out of it. So that's how we're looking at this whole, investments by government and the push of capex to benefit our portfolio.
All right, thank you so much for your answer. Very eye-opening. So for my last question, I'd like to discuss the impact of monetary policy on specific sectors. So what we've noticed is that NBFCs and consumption often lead when rates fall or when liquidity is high. So tell me, Darshan, why do these sectors benefit and how is that influencing your portfolio calls?
Sure. So first of all, what happens is that when the RBI decides to cut interest rates and ease liquidity into the system, it is primarily with a view to boost the consumption side of the economy. The government obviously has already acted on the supply side of the economy, but you need a demand push as well. In the past few years, in fact, interestingly, the consumption side of the economy has slowed down considerably. This was in part because the RBI last year had been on a tightening curve. I mean, on a tightening spree. It had increased interest rate. It had put stringent regulations in place for NBFCs to lend to the entire ecosystem. Now, in this year, we saw that the RBI reversed its stance, and therefore, what we have seen is that rates have started to be come down. Liquidity has improved into the system. Now, the banking liquidity is in a positive territory for the past several months now. Now, what does that mean? One is that it pushes banks and NBFCs to reduce the rates onto the in their system so that they can improve the borrowing and the credit growth in the system. Now, here you have to understand that when the rate cut happens, the banks have to are forced to pass on the rate cut benefit immediately into their clients. Whereas in case of NBFCs, they follow an internal rating system and therefore they are not really forced to cut interest rates to to their clients, because in case of NBFCs, they have a higher share of borrowings which are linked to floating rates. So basically, NBFCs also borrow. So for them, the main raw material is capital, and they get the raw material from banks or from public markets in the form of NCDs or fixed deposits and so on, which are generally, they can introduce new instruments into the system to get lower rated funds for their as their raw material. However, when it comes to passing on this money to clients who are basically retail borrowers or SME borrowers or even corporate borrowers, they are not in a hurry to bring pass on this rate cuts. So therefore, they enjoy a period where they enjoy higher yields, basically higher difference between the rates at which they lend and the rates at which they borrow. So therefore, it leads to a period where the NIMS, which is basically net interest margin, so for them, the margins improve over a period of time in a rate cut cycle. What this means is that they are able to enjoy the benefits of higher margin and improve their financial profile in the form of better ROA as well as better return on equity. And this leads to a period where they enjoy good earnings growth as well as re-rating uh, on their valuations. Uh, what we also have understood is that for example, segments like vehicle finance, consumer durable finance, these kind of NBFCs are more favorably placed in a rate cut cycle compared to some of the other NBFCs, like say housing finance, which have to immediately pass on the rate cuts to the borrowers. Uh, the other beneficiary of obviously is the consumer itself. Now, Sandeep already touched upon the benefits of a rate cut to the consumption side of the economy and how a lot of people benefit from that. But I will just reiterate some of those points. So obvious benefit is that the EMIs come down. Secondly, it leads to lower incremental borrowing rates, which in turn helps improve the household budget. So last year the budgets were constrained and that led to a significant slowdown in the consumption. Now that the rates are lower, the EMIs are lower, and the personal loan rates or even other forms of borrowing rates have come down, it helps them to free up the budget, and which they, in turn they can use to spend on a variety of areas. Obviously, the significant boost happens to the basic goods, but basic goods are a necessity, and therefore, even in a tough environment, you still have to buy them. But this higher discretionary income that is now in your hands, you try and use it on some higher ticket value items, or say more options, like for example you would be willing to go out more often into hotels and restaurants. You would be willing to take more travel trips. You will be willing to maybe even buy a new vehicle, upgrade your house. So there are various areas of spends which come into play when interest rate cuts happen. Apart from interest rate cuts, I would like to add one more point over here. We also have to understand that government on its part has also taken some steps to boost the consumption. The biggest one last year was, I mean, in last financial year, was the tax rate cut at the bottom part of the income pyramid of India, where the government has tried to now bring almost effectively zero tax rate for people who earn up to say around 12 lakh rupees annually. Now, this is a significant boost to the consumption side of the economy, and this will play out over multiple quarters. It's not a one quarter phenomenon. Secondly, we also have to understand that the government is due to implement the eighth pay commission, which is expected from 1st Jan 2026. That will lead around 49 lakh government employees and almost 65 lakh pensioners who will benefit from this increased income in their hands. And we have seen in the past that every such pay commission implementation has led to a significant boost to the consumption part of the economy for multiple years post the implementation. So this will start playing out more from FY27. The obvious benefits of these will be the consumer, retail, and discretionary segments, as Sandeep already mentioned. In addition, because of the significant additional income in the hands of the households, you will see a rise in spending on areas like real estate, passenger cars, apparel, premiumization of these various consumption segments, and consumer durables. So we will see a lot more consumption positivity in the coming quarters, which will in turn lead to improvement in the demand and the growth profile of companies which are exposed to these sectors. Thank you.
Thank you so much, Darshan, for such an eye opening answer. This brings us to the end of this episode of Market Thalaivas. We've unpacked how the forces driving market sentiment. A big thank you to Mr. Sandeep Tulsiyan and Mr. Darshan Engineer for sharing their sharp insights and cutting through the noise with clarity. As always, we hope you're walking away with a deeper understanding of how micro moves translate into market strategy. Until next time, stay curious and stay invested, and keep watching Market Thalaivas, powered by Sundaram Alternates.
Thank you. Thank you.
Thank you. Thank you so much.